Hey, can you hear it? Can you hear the leaks dripping out the bucket of your business? That's your profit escaping, and most CEOs don't even notice until the bucket is empty. Hey, founders, welcome back to the channel. I am Michelle Mitchell. I am your fractional CFO and founder of Mitchell Consulting and head cheerleader to help you grow your bottom line. In episode one, we talked about measuring your profit for your agency's profit health. Today, we're going to talk about how we plug the leaks of revenue and earnings in your business and how to actually make it stick. So, the silence killers aren't loud like a credit card decline. Like, they're not like that. They actually lurk in your meeting minutes, the loose processes in your business, the quick favors that you do for clients, the tiny drips that add up to a Niagara Fall by December. Those are the leaky profits, and they're killing your business. So, I have 5 leaky profits killers that we're going to go through today. And they are going to help you recognize like the small little leaks before the bucket just tumbles over into a waterfall. And the first one we're going to talk about is underpricing your services. Underpricing your services sounds like, when was the last time you had a price increase or you increased your rates? If it's been longer than the time it can take for you to go run to the store and back, then it's been too long. Because inflation is actually eating 8 to 10% of your margin every single year. And if you're not adjusting for margin and inflation rates in your business, then you're leaving money on the table and your profit margins are decreasing. We deal with finances. Every single year, QuickBooks has a price increase in August. They don't ask our permission, they just do it. They notify us, then they just do it. Like, but we as CEOs, we're not doing that for our businesses because we have personal feelings attached to it, right? Or maybe you're giving discounts to your friends and your friends' friends, and that 10% adds up over time. So if we do some quick math, if you're undercharging or underbilling your clients, let's just say it's $500 times the number of projects that you're doing times the number of months. And over time, it could be $30,000. Like, what would you do with an extra $30,000? You could actually pay yourself more and it impacts your family. Like, it could be the difference between that good daycare versus a great daycare. Like, it could be a difference between, having a staycation versus taking a luxury vacation for yourself. That's the difference. But those profits are leaking out of your business every single day if you're not paying attention to it. So, what do we do to plug the leaks in your bucket? One of the things is your time. Like, your time is leaking out the bucket because you're not charging clients for this or that, or actually you're working on lower profit margin activities where you should be interacting with clients more or going to get clients more, and that's leaking out your bucket. So I want you to start by plugging your own leak for the CEO. So calculate what your effective hourly rate is for the last quarter. And I want you to take a look at how much time you've worked in the last quarter, like actual time, and how much you actually paid yourself. I want you to take the amount you paid yourself and divide it by the number of hours you actually worked. And if that effective hourly rate is too low, then it's time for a price increase. It's time to change what you're doing in your business. There's still time. And there was a time in my business where every time I got a new client, I actually increased the rate because my profit margins weren't where I wanted them to be, and I wanted to increase them. So I increased them over time as we brought in new clients. Now, number two is actually scope creep that is leaking out the bucket of your business, of your profits. Um, does this happen to you? Someone asks for an extra revision, or can you just hop on Zoom real quick? Or can you tweak that? And every time that those tweaks aren't in your proposal and you're not getting paid for them, they're leaking out the profit in your business. And if you have a team, let's just say you have a team member doing things in the business for clients and it's not part of the scope of work. What if they're giving away 2 hours per week for free that you're not being paid for? And let's just say you got three team members giving away 2 hours a week. That's 312 hours in a year. At an effective hourly rate of $150, that's $46,800. You could actually hire a strategic person into your firm for that rate, for them giving away 2 hours a week for out of scope work. So to plug this leak, implement something that will track out of scope work. And then you just need to tell the client, well, this is outside the scope of our work that we agreed upon. So it's going to be an additional fee, and then charge them the additional fee because you're worth it. They're asking you to do the work. Number three, inefficient processes. Like inefficient processes is really where the rubber meets the road in a business and an agency that's trying to scale. So if we don't have our processes down tight and we're trying to delegate work to our team and that work is not being done in an efficient way, we are actually leaking profits out of our business. So for instance, just copy pasting from one system into another system. It is taking your team an extra 15 minutes to copy paste every time they have to do it for all the clients that you have. That adds up. And you could actually hire or engage with a software automation system for $10 to $20 a month that can do the same thing for you, and you're saving that redundant time that your team is spending doing the copy and pasting from one system to another. There are systems out there now like Zapier and Make that can make this process easier for you, and you can use your team to do higher level work instead of copy pasting. That's another way you can save money in your business and you can plug this hole of inefficient work. So, number four is that you have poor client fits. So, you onboard clients and they become high maintenance and low margin. So, because they're constantly coming back to you for things that are outside of your scope, or the client is just not a good fit for the process that you have in your business, it's costing you money when that happens. Like currently, my team is going through our client list and we are trying to figure out which clients are that we like which clients that we love working with and which clients that, there's a bit of an factor. Like when you see their email pop up or you see their phone number come on your phone, like how does it make you feel? And if there's any ick factor in the way you feel when you see their name or phone number pop up, it's going to be better for the business if you just let them go. Let them go to someone who can actually attend to their needs the way they want to be attended to. But this is costing you. This can cost you, five to $10,000 if you onboarded a client. And we know as professional service providers that the bulk of our work happens at the beginning of the engagement, and then we implement processes to make this go more efficiently and easier. We know that if after the onboard that this client actually churns, like they actually go away, it's costing you money. So if we really lean into finding the right types of clients to come into our agencies or our firms, then we want to elevate the lifetime value of our clients. And we can make more profit the longer we have these clients on our rosters. But we first have to have the right types of clients on our roster. So, to plug this leak, maybe one of the things you could do is do a smaller project coming in so you can see how well you're going to jive and work with this new client. Or, like, after they're onboarded and maybe you've gone back and forth about reining them back into the scope of work, maybe give them a PETA score and add something to their bill if you want to keep them. You know, in my opinion, you might not want to keep them because they're just not a good fit for the type of business that you have and the types of clients you want to serve. So, but that's a big leak in the bucket of your business. And then the fifth point is our overhead bloat. We all have it. I'm constantly going through what are we spending money on and are we getting a return on what we're spending money on? Like, are we getting a return for all the software? Like, are we using all the capabilities of the softwares that we're bringing on board? Is there overlap between two softwares and now we're paying for two softwares that basically can do the same thing, but because this one over here had a better feature, we decided to keep it, and now we have two. Well, that can add 10 to 20% to your expenses every year when you're not using a software subscription, or maybe you have too many seats in a software subscription, or maybe, I hate to say it, the subscription is dormant. Like you purchased it, but you're not using it. That impacts your bottom line as well. You could save $3,000 to $6,000 a year just by doing an audit of your software expenses and any other overhead expenses that you have. Maybe is that you as the business owner, you're part of a lot of different programs, but you don't utilize the benefits of those programs. So then it's costing you, right? It's costing you to maintain them, to be a part of them. You should just go through all of your expenses, make sure that everything that you are paying for, you're actually getting a benefit from. And all of this rolls up into closing the leaks in the bucket of your profits. So, just to recap, one, underpricing. You need to fix underpricing. Number two, scope creep. Are your clients getting outside of scope of work? If they are, you need to rein them back in or give them a new quote. Number three, manual processes. If you're not leaning into technology to improve manual processes, you're losing money out of your profits. And then overhead bloat is number four. Like we need to plug all of these areas in our businesses so that we are maintaining profit, so that you, as the owner, can utilize the profit in the business as well as in your personal life, because that's what you get paid from. It's the profit. How well do you manage the business so that you can earn more? So I hope this was helpful. If you would put in the chat below, like which one of these do you resonate with? Which one of these do you need to work on in this period of time of the year? So that as we go into the fall and winter months, we have clarity as CEOs that we know what we're working on and how it impacts our bottom line. Because at the end of the day, if you don't have profit, you don't have cash flow in your business. So if you need help with any of that, you can reach me by clicking the link below. Jump on my calendar, 15 minutes, and we can help you move along your path to profitability. So until next time, I'll talk to you soon.